Good afternoon and welcome back to the latest edition of the InvestTalk market analysis for the week ending March 28th, 2025. This week I'm titling a video Gold Shines as Bears Gain Control of Equities. And I say that because we did get a pretty rough close to the week. But overall, equities are up. S&P was up on the week, but you can see there's definitely pockets of weakness, which I'll show you in a second. Kind of total return for the week, but there's a story emerging, and it's something that I had an inkling we would have this year, which is this is starting to look a lot like 2022. Okay, where tech is really falling out of bed, and but there are other sectors that are holding up just fine, and one sector in particular that is doing quite well. And so I'll show you that chart here, but this is the heat map for the week. So you can see Nvidia down pretty big, Google, Tesla, and Apple were up, but broader tech, Broadcom down pretty big, over 10% there. Oracle down 7. So what you can use technology, a lot of red, and especially the bigger the name, the redder it tends to be. Now there was some strength here. You see in energy, green pretty much across the board. Consumer staples also strong there. Utilities a bit mixed, which I'll show you is actually down on the week overall. But in healthcare too, that was fairly red. And what you can see here is I'm going to look at the performance for this week. Okay. And you can see the bottom one down 3.3% was technology. That just really drove the market down overall. Excuse me. The market was down actually this week. I apologize, 1.5% on the S&P, and you can see that mainly driven by tech. What else was down? Industrials down 1.3%, healthcare down 1 and a quarter. Financials were only down 0.15%, so really a modest drop, kind of a flat week for financials. And if I go over here too, what you can see is definitely some banks, bigger banks, Morgan Stanley, investment banks, Blackstone, anything that's fairly high risk. Those were down. What held up the sector was really the insurance space. You see Chubb here up a little bit. You see MMC, another insurance company, up, Progressive up. So that's what really held financials up. The banks were definitely weaker overall. What else was up? Energy was up. You had consumer staples up 1.9%. Consumer discretionary, that was about flat though, up 0.06% there. So, and real estate, that was up about 0.4%. So, certainly a mixed bag, but you can see what's driving the market lower. Now, what I want to do is zoom out here, and let me zoom out to full year. Okay, and I'll show you why this is starting to look a lot like 2022. This is the total return for the year of the 11 different sectors in the S&P. So what's the best sector? Energy, 8.74%. Okay, up, positive. What's dragging down the indices? Technology down 11%, consumer discretionary down 12%, and overall the SP is down about 5% on the year, 4.9%. But you can see there are sectors that are up. From financial services are still up 2%, healthcare is up nearly 4, same with utilities, real estate up 2.5 or so, and communication services, that's about flat on the year. Basic materials are up 3.5, driven by gold, like I've talked about. Staples up 3%. So what I'm showing you here is the market's not going to hell in a handbasket. It's just tech and consumer discretionary mainly that's driving down the markets. The rest of the sectors are either slightly positive or nicely positive, like energy, or neutral. Okay. Now, what I want to do is show you what it looked like in 2022. Okay, so I'm going to zoom out here. This is the full year up until now, or sorry, from the end of 2021. It's when really the market started rolling over in earnest in 2022, and then for till today, what you can see is the total return. Energy is actually doing the best. So, and then that's followed by financials, and then that's followed by industrials up 29%. Then you have technologies at 22. So despite the strength in technology over the last couple of years, technology still is somewhat in the middling return for the entire market over the last 3+ years. call 3 years and a quarter. So I think that's telling. And then if you zoom out to, let's go to 2022. I want to do March. I wanted to do December. There we go. So this is the full year 2022. This is the year that the SP was down about 20%, 18%, call it, including dividends. NASDAQ was down 33%. And you can see here, what was the worst sector? Communication services. So that was Meta. Meta really drove that. Google. And then technology, 27%. Consumer discretionary down 36%. Real estate was down 26. That was really driven by the higher interest rates in 2022. It was interesting, even though it was higher interest rates, industrials, or sorry, and utilities actually held up that year, up 1.4%, second best sector in 2022. The best sector was, once again, energy. But even the other sectors, there wasn't a lot of damage there. Staples were pretty much flat on the year. Industrial was only down 5. Healthcare was only down 4. Financial services, even though you had a rough market, were only on 10. So there were definitely subsectors there that did fairly well. Once again, insurance is mainly the investment banks and anything related to private equity that really was down big in 2022. So what you're seeing here are a lot of parallels to 2022. Now, is that durable throughout the year? Maybe not. But it's starting, these trends start to feed on themselves and money starts to flow. And you're starting to see money shift out of big tech, even out of US and into foreign markets and into these other sectors that have steady, if not growing earnings. Okay. So I wanted to highlight that because it's important to kind of see these trends. Now, pivoting over to the economic news, Richmond Fed, manufacturing this is March, so this is fairly recent, and this dipped down into negative territory. So with all the tariffs, it's not really pushing domestic manufacturing higher. New single family homes, this is February, so it's a bit old. It's kind of steady state, right? In this, call it 650 to 700,000 new homes being sold. That's where we've been pretty much for the last 2 years. So I don't see that changing materially. Durable goods new orders, same kind of thing. You're not really getting good growth. It is up about 5% year over year, month, up about 1% month over month. So that's fine as well. Initial jobless claims, initial claims for unemployment insurance, that was flat. Continuous claims, still kind of in this choppy pattern. So the labor market is relatively steady. The Kansas City Fed Manufacturing Index, that did tick up, and this is a little, once again, more recent. So that's positive. So kind of counter to the Richmond. So if you bring those two together, that's fairly neutral. Pending home sales year over year remains down 3%. Okay, so most of the activities continues to happen in the new home market. Now, the inflation fronts came out Friday, so the broad PCE that was roughly flat, about 2.5%. Core ticked up to 2.8, and then the 12-month trimmed PCE, which is what the Fed tends to look at, that did tick down to 2.6. So everyone focused on these, but the Fed looks at this most of all. So this could give them a little bit more headway to cut. And that's what I wanted to talk about next is what the Fed is likely to do at their next meeting coming up on May 7th. So we still have 5+ weeks. We just had a Fed meeting, but the odds of a cut there last week rose from 14 up to 18.5. And if you continue to get weakness, get credit spreads continue to widen, that could precipitate a Fed rate cut along with a continuation of winding down QT. Maybe they end QT entirely. I could see that happening as well. I do think by year end, the Fed institutes QE, but only towards the Treasury market. So that's something I'll be watching. By year end, our now base case, market's base case is basically 3 to 4 cuts, 3 to 4 cuts in that range. Now the GDP now figure that is taking another leg lower with the overall market. It's interesting. It actually kind of looks like the overall market, right? So based on different models, they've either negative 4.7 or negative 2.5. Okay. Now a lot of that has to do with imports, etc. I also want to talk about this. This is Bitcoin. Bitcoin is now at 82,000. It's, as I said before, you break 90, that is a forward-looking indicator for the broader markets. And as long as you stay below that, likely this leads the market lower. Now, interesting enough, it hasn't broken the recent lows, which were in the high 70s. Right? It's about 78,500 back on the 10th. So we haven't broken below that. This here on a Saturday is still not there. But so as long as that kind of hangs in this area, maybe the market holds up as well. Then I want to get to this, which is consumer credit, bank credit, excuse me, bank credit. And we've said this before. If I zoom out, what banks are doing. Are they lending more, lending less? Is this trending higher? Is it trending lower? Is very material to what happens in the broader economy. Okay. And it can be volatile, which you can see if I zoom out to max. This is '08, right, where you just had a complete collapse of bank credit growth, and it obviously took until about 2012 when this started to really accelerate for uh, to spin really out of the malaise that '08 crisis put on our economy. One year, this stuff started to slow. It peaked out about 3.9%. We're still kind of in the 3.25% growth. That's pretty solid. But I'll be watching. Is this just a consolidation before another acceleration above 4%, or do we break down below 3 and then now you have a downtrend? I'll be watching that. Obviously, the tariff situation, that's not good for the expectations of banks, right? If they're worried, if companies are worried about what tariffs will do, what does that mean for the broader economy and lending? And so, I am not optimistic that that will turn around, but you can't sit here and prognosticate. You have to watch the data and then react. So that's where we're at. Now let's get to the equity markets, and I'll start off with the S&P. So there we go. So this is the S&P. What you can see here is we found that support at the 618, and we are threatening to. We rolled over on Thursday, Friday, or call it Wednesday, Thursday, Friday. We had the nice start to the week, couple days, a pause, and then a failure, and then we had that follow through lower. Now, this is somewhat bearish. I go to the Qs. It's obviously weaker. We're pretty much at those lows. You can see that relative weakness happening there. Now, this could also be what I call an H pattern, kind of a reverse H pattern, where you get a actually higher low here, and that's actually fairly bullish. Or do you truly break down? Now, if we look at the NYSE, this is a bit stronger. You see the small caps, more like the S&P than the Qs. So you're starting to see some outperformance of the Qs, sorry, of small caps over the Qs, even especially if you go to like EFA. So the foreign markets, which you can see here this is after years of the Qs outperforming. This goes down, this means the Qs are outperforming. And you had this in 2022, right? So it's going back to echoes of 2022. It looks very similar, right? An uptrend of foreign stocks over outperforming the Nasdaq. Now you have the counter trend rally here, counter trend outperformance, and now we're getting this once again. Now, if I zoom over to this chart, which I always kind of talk about, which is the growth to value trade. This goes back all the way to 2000. If I zoom out to a monthly chart here. So this means growth's outperforming. When it's going up, and it means values outperforming is going down. So this is the tech bubble bursting all the way till basically 2007, when the banks started to collapse, right, which are part of the value side of the market. That's when growth started to outperform, and it outperformed really for over about 14 years. Okay, and we peaked out, right? You had a MACD divergence here on this new high in 2021, and that rolled over. Found support at the 100-day moving average, counter trend rally here. But what is this now? A lower high, and this is threatening on the monthly, especially. We'll find out on Monday whether we get a follow through and close below where we were this month, which is December of last year, when we had that surge higher in growth stocks, and that was kind of the end of it, right here. And since the start of the year, we've had that rollover, and now you're seeing value reassert itself to the upside and find that strength in those tech stocks just struggling. And this is mirroring a lot of what the market's doing. You see the MACD below the zero line. And so what I think is this value over growth trend is in place, and it is set for, I think, the entire year. It's going to be a challenging year if you're in the wrong sectors, pretty much. And that's what I'm seeing, and those trends continue to play out. Let's go to the move index. This is also a bit of a worry if this gets some traction to the upside. So this will force the Fed's hand to wind down QT quicker than expected, and maybe even do QE if this gets out of control. And a lot depends on where the economy goes, what the tax policy will be of the Trump administration and the Republicans. All of this makes for a volatile period, because there's a lot of uncertainty, and they're playing with fire when you're trying to keep the treasury market intact. And the more they the more they instill uncertainty into the markets, the rougher or the higher this move index will probably go, and the more volatility will be put into equities. Okay, so just be on the lookout for that. And this is here's the Nasdaq. You can see here. You So I'll give you a little lesson here. So the third time that you hit a trend line, you typically pierce it, and then you get a bounce, and then you'll see where we go from there. And typically you get an eventual rollover. Now, this rollover was pretty quick, so it's things have to be materially deteriorating for this to break the support so quickly. It would not shock me to get a bit of a bit of a rally, because sentiment is pretty bad, and a more choppy period before a true breakdown. Now, we could break down from here. I do not rule that out by any stretch of the imagination. Okay, if we go back to 2022, right, you had the rollover, you had an initial bounce right at the 200-day moving average. This is January 2022, and then a quick rollover, and then you can see just serious. Every rally was sold, right? And the 100-day moving average, 200-day moving average, just sold until sentiment got really bad in the fall, and then you had the rally. Right? You had the MACD divergence the other way, where MACD, you had the retesting this low, you had this big reversal bar, and we never closed below it. And this was one of those, okay, you had this sloppy bullish pattern, positive MACD, and then we rallied from there. Now you're getting the opposite, right? You're getting this, not a new high, right? This breakdown. Look at this. This actually mirrors it, right? Where you get the breakdown bar here back on the 18th of December, and you never broke above it. And I said that. Until you break above that, this is bearish. This is a sloppy bearish pattern, and we fall through to the downside. So that's kind of what I'm expecting. Could easily get rallies sparked by headlines. Headlines are going to continue to be crazy, and just be on the lookout for that. What else do I want to get to? Gold, 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 gold. I have to get the gold. I have to get the gold. Here's silver. Silver, just strong. Not as strong as gold, but strong. And what's interesting is you're starting to see some inflows into gold by the retail investors over the last 2 weeks. this is an area that has not been paid attention to. I've said this, gold just makes new highs, no one's talking about it. People are starting to talk about it again. Now, typically that means you get a pullback. It would not shock me to get a bit of a pullback, probably similar to what you got back in November and December, especially if the market does break down, kind of sell everything type of thing. And you sell what you can and not what you want to, type of thing. And that could happen as well. So gold's a bit overbought, but it's in a durable uptrend. And look how wide this gap is between the 200 and 100-day moving average. When you see that, that is a signal, sign of strength, and that just makes me even more bullish on gold over the medium to long term. Especially this uncertainty with the Trump administration and geopolitical unrest, and the thing with the Houthis and the Signal app and all of this is creating a lot of uncertainty in global markets. And gold is a safe haven asset. Okay. And you can see this, the dollar's rolled over. This looks like in a downtrend. If I just move over to some single currencies, right, you have this break up in the euro, and this is just consolidating. Okay. You have the yen, right? Breakout, pull back, and just an uptrend. And I expect the yen to remain strong as well. And this is part of, I think, the Trump administration's plan is to weaken the dollar, and that ultimately, when the dollar weakens, foreign holders of U.S. equities tend to flow out. And what are they owning? They're owning the Mag 7. They're owning the big tech names. They're owning the indexes, which are overweight those Mag 7 names. So it's not shocking to see a weak dollar coincide with a sell-off in equities, especially those Mag 7 names. So just to be aware of that, what's driving this is certainly a weaker dollar and that geopolitical unrest. What else do I want to get to? It's the credit markets. So what you can see here is credit spreads are widening. This is short-term junk to short-term treasuries. And when this is weak, this means that credit conditions are deteriorating. Now, you're still in an uptrend, right? You've had these sell-offs. This was back in July of last year when Nvidia and carry trade unwind. And you're not breaking below those levels. This is still making a series of higher highs and higher lows. So it's not ringing giant alarm bells for the broader economy. But it is of note, and it's something that I will continue to watch to see if there is a material breakdown here. What else? I think that's about it. I'll leave you with that. This is